What is up, guys? It's Chasin. I'm here with your Q4 2022 update. There's a whole bunch going on with the market. This is the first time we've seen a little bit of uncertainty in quite some time, so I'm excited to bring you this update. And let's just get right into it and break it down. All right, so in January of 2022, this year, the median price of the home in Orange County started going up. And the reason for that is because we still had mortgage rates at 3% interest. We were able to get mortgage rates of 3% because the Fed was purchasing mortgage-backed securities. So everybody hears about the Fed and they hear that, oh, the Fed is raising rates or lowering rates. But what they do with interest rates is only part of what they can do. During COVID, they actually stepped in and started buying mortgages or mortgage-backed securities to bring down interest rates so that payments would become more affordable. So that's where we were in January. Now, this $1 million property with payments of $4,300 a month, well, that same home rents for $4,300 a month. So a ton of people were willing to buy in that scenario, and rightfully so. But now as we fast forward to September 2022, which is where we're wrapping up, well, the Fed has backed off purchasing those. Not only have they stopped purchasing mortgage-backed securities, but they're actually unwinding and they're selling them back into the marketplace. So they're increasing the supply of available mortgage-backed securities, which means mortgage rates have to go up in order to meet the amount of supply. That might be counterintuitive, but point being is when there's more mortgage-backed securities available, in order to entice investors to get them, they have to be sold at higher interest rates. And then once they're higher interest rates, then investors will have the appetite to go get them. So what does that mean to you as the consumer? Well, if we're still at the $1 million median price, well, the 5.75, well, payments are way up. They're up 28% up from the beginning of the year, or over $1,200 a month. So that is really punitive. That's penalizing towards any particular buyer. So this policy by the Fed is making it very difficult for people to purchase property. And the Fed is doing this intentionally, by the way, because of inflation and how it's running out of control. So they're trying to get a hold of it. So they're trying to bring up interest rates as high as they possibly can, as fast as they can, to stop asset prices from going up, and that includes food costs, gas costs, all energy costs, the broad spectrum of the economy. So, I started asking myself, I said, well, can the market sustain $1,200 more a month or not? And the answer to that appears to be no. So property values have started declining about 7% already, the median price since the beginning of the year. So that 7% is some relief, but it's not really enough relief. So here's a $930,000 price just as a 7% decline, okay? Well, this is bringing payments a lot closer with a 7% decline in median price, but it's not all the way there. So I said, well, what would the price have to be to get all the way there at these mortgage rates? And the answer kind of shocked me. I was actually pretty scared about it, where it said, wow, well, prices have to come down 17% from January in order to get the same monthly payments as they were in January at a 5.75% interest rate. So I looked at that and I said, there's going to be a lot of unhappy people if the values of their home go down over $100,000, in this case, $177,000 in Orange County. Well, this begs the question, well, is this what's going to happen? And my answer is no. It's not going to happen for a couple reasons, but this is certainly an eye-opening revelation that as people start losing money on the value of their home, they're going to feel poorer. And as they feel poorer, they're going to scale back, and then we're going to have some sort of economic challenge here. And I think you're going to see the stock market pull back more, and eventually that fear factor is going to put money back into mortgage-backed securities, which are considered safe investments, and it's going to push the mortgage rates back into the 4s next year. So if that happens, as mortgage rates go down, this median price will stabilize a little bit higher. So, I look at this and I say, well, does that mean everybody who bought a house at $1 million is screwed? No, not at all. And the reason why not at all is because they got the 3% interest rate. So they're sitting at $4,300 a month, which they can't even rent their house for at this point, so they're just going to stay put. And they're not going to list the house. And as they stay put, it's going to keep and restrict the supply of homes for sale. And as the supply of homes for sale is restricted, it's going to limit how many of these homes will actually come down in value. So if you ask me, I think we're going to end up somewhere in this neighborhood next year. And if you're a seller right now, that means sell immediately. Get on the market, try and sell before you net at this bottom, assuming you have somewhere else to go. If you don't have somewhere else to go and you have a 3% rate, then there's no need to do anything. But if you do need to move, it is better to sell first right now and then buy second in a declining or a depreciating market. So, obviously that's enormously important. If you're a buyer, you want to be on this side and say, okay, well, if somebody's listing for a million right now, I need to get this for at least 7 to 8% below market before it starts becoming worth my time, so I can hedge this downside risk. And what I tell people is the time to buy is when there's the least amount of people buying. And so that psychology is moving away from it's a good time to buy to it's a bad time to buy. And you get deals when people believe or perceive it's a bad time to buy. And so I'm already looking at this, and I am actively submitting offers significantly below list price on behalf of buyers. And I'm just feeling out where sellers are at and seeing what their motivation is. That's what I believe to be the right answer right now. If you wait years and years down the line and hope that prices keep coming down, well, by the time the prices do get down to whatever the bottom is, you're going to have to contend with other buyer demand again, and so you're not necessarily helping yourself out. So as you know, I like to take a data-based analytical approach to where we're at in the market, and this is where I believe we are. So we'll see how this projection plays out, but as you know, I try to be a thought leader. I try to position my clients in the best way possible financially with respect to their real estate assets. So that's where we're at, and good luck, and let me know if you have any questions. All right, thanks, guys.